Welcome back, and welcome if it's your first time here. Today we're going to do something a little bit different. I'm going to show you exactly what I look at and how simple it can really be to build a pretty big portfolio pretty quickly. This is a couple snippets from my ebook, and I really only look at four things to keep it really simple. I think so many people overcomplicate investing, and it really is the detriment of them, and it causes them to be unsuccessful, and they could really make so much more money if they would just simplify things. So many people like to day trade, they like to do covered call options, trying to get like high income so they can retire in like a couple of years. And nobody really finds success doing those things. And the people that do, it's such a small percent that I have shown this specific strategy that I've shown in my previous videos to a few people, and all of them have found great success. And as long as you stick to the plan, you're going to do very well. So, really, I only look at four things. I look at past performance, the holdings within the company, within the ETF, the distributions, meaning dividends, and the expense ratio. So, past performance would be the first one we can look at. And keep in mind, past performance is not indicative necessarily of future gains. However, it can be a good indicator. So my favorite things to buy are VGT and FTEC, which are essentially the same thing. So VGT here, you can see the last 5 years. That's a chart that I like. If I go to max, that's also a chart that I like. A chart that I wouldn't like would be something like Tesla. I know it's not an ETF, but to give an illustration of something that is just super volatile and you don't really know what's going to happen next. There's a lot of ups and downs. Another example would be another individual stock, AT&T stock. It's a dividend stock, so some people might think, "Hey, I'm going to do this, and I like the dividend growth, I like the payments." But keep in mind, you get both with growth stocks. Like, here's a few growth stocks you might like. So there's VUG. Your growth looks fantastic. Over the last 5 years, you would have doubled your money. Max looks fantastic. Like, that's a chart I can get behind. If there's a big dip, you see that it always rallies up. So let's look at 2008. It's a little speed bump in the grand scheme of things. Let's check out SCHG. That's another one that a lot of people like. So here's another one very similar to VUG, past 5 years, 112%. It's a little, so when we look at holdings, you'll see that VGT is almost exclusively tech, something like this. You can't quite see the 2008 crash. Maybe you can kind of see that it started around the 2008, 2009 time, but it's going to look very similar to VUG, which we just looked at. And then FTEC, like I mentioned, it's essentially the same exact thing. It has like the same holdings as VGT, give or take like a percent a year. One more would be a little heavier in semiconductors, which we'll look at in a little bit with our holdings, would be XLK. So 5 years max. I'm always looking at long time horizons. So the inception of XLK was 1998. So you can see that it's been around a long time. You got to see the dot-com crash. And you got to see that it took a long time. Even like the '08 was a speed bump, even though that was one of the biggest recessions. But you can see that like you can get a dot-com crash, and that could happen at any time. It could happen up here too. That's why it's good to be not just in one sector, which shame on me for being almost all in one sector, right? But I believe tech is the future, and that's why I do that. I do think it's good to have an anchor like SCG or VOO or something that's not just in one sector, just in case you would get a dot-com crash like that. So let's see here. From my ebook, we have holdings next. So let's look at some of the holdings. Let's start with XLK since we're already on it. So you want to see that these are one companies that you are familiar with, because if you're familiar with them, they're probably doing pretty well. So you have NVIDIA here, 14% of the weighting, meaning that as NVIDIA goes up and down, it has the most impact out of all of these. Microsoft would be the next. Apple would be the next. You've heard of Palantir, which has done very well in the last couple of years. You've even heard of like Salesforce and AMD for most of you, right? So let's do something like SCHG Holdings, which is going to be a little bit less focused on one sector. You can see over here, like the sector weightings, it's still heavy in technology, but you've got some communication, you've got some financial, you've got some consumer cyclical, which would be like Walmart, Walgreens, like consumer companies. So still you can see though that most of it is in Nvidia, Microsoft, Apple. Then you have even some consumer, maybe like Amazon, and then you have some Tesla, and you have some what would that be? Financial services like Visa, MasterCard, maybe Robinhood, things like that. So you get a little bit of diversity in there. So it's not bad to hold both. Both would be great, right? So then let's go my favorite VGT. VGT has had the most promising over the past 20 years results of anything I've found, but it like I've mentioned, it's almost exclusively tech, right? So you have like nothing in any of these other categories. So you have Nvidia, 17%. So Nvidia has obviously done really well the past few years. I held VGT for the last, I don't know, 4, 5, 6 years. And during that time period, Nvidia had a much smaller holding. So that's one nice thing with ETFs is when you are buying ETFs, you don't have to think and stress every single day about do I have to shift around my portfolio? This happens for you automatically. So only tech companies will go into VGT, whereas with VUG or with SCHG, you will find that they diversify in some of those other sectors like we've seen over here. So you do get some exposure to things like Palantir because it is a tech company. You still get like Cisco, which is awesome. They've done really good. What was it? I want to say Broadcom has been just absolutely roaring. Let's see, just out of curiosity. 1 year, 92%, 5 year, 800%, right? That's pretty fantastic. And then, like, that looks great. But again, you might have like a dot-com bubble. You never know when that's going to happen. However, I will say when something like a dot-com bubble does happen, that type of thing is the greatest opportunity because more like I only buy ETFs. I only advocate for buying ETFs. And when that happens, you get so many shares at a discount for just years on end. And then when it goes up, boom, you are just freaking, you're going to the moon, baby. So let's see here. Let's do like one or two more here. What did we talk about? We talked about VGT, VUG. Let's check out VUG real quick. So I got to change this, but I have to go to Google first because it takes me to Bing and I need to change my main search engine. It's driving me nuts. I hate Bing so much. So Yahoo. Yahoo's a great place. You can check out sector weightings really easily. You can check out your top 10 holdings really easily. And then in a little bit, we're going to talk about your cost to hold these ETFs instead of using like a financial advisor and paying someone 1%, 2% in fees for them to underperform these ETFs. You can do this so easily yourself. No, there is risk. Like you can lose money with anything, but with ETFs, if you're not using margin, you can't lose money unless you sell. So again, VUG is going to be a lot more like SCHG. You do have some financial services, probably a little less. You do have some consumer, and you have some communications, which would be like AT&T, Verizon. Probably like I don't know if Broadcom would fall under communications or if it would fall under technology or like a combination. I would have to look into that. But again, Nvidia, top performer, right? Like top weighting, I should say. And then you have Microsoft, Apple, Amazon. Again, you get a little more exposure to other companies. So it's not a bad idea if you want your anchor, meaning your most held ETF that you're going to hold, your largest position. Maybe you want to anchor it in addition with something like VUG or SCHG or VOO. Like in my portfolio, hopefully I'm not logged out. Great. I hold some VOO too, right? So I have like 10% of my portfolio is VOO. I sort of treat it like a bond. It helps me when the market downturns and it provides me with the dividends that so many people aspire to have. So that helps me cover some of my margin payment with the fact that it pays a little more in dividends. I'll show you guys that in the future video here, the cash flow sheet. But let's see here. Next topic would be distribution. So dividends, right? So like everybody cares about dividends. I also care about dividends, but it's not my top focus. My top focus is growth because you can grow so much faster when dividends aren't your primary area of focus. So what I mean here is I'll see a lot of people, they care a lot about buying income stocks. So they might buy, my favorite example is AT&T because I don't look into income stocks as much as I should. I just know that what I'm doing with growth works so much better. So what I mean here is A lot of people will buy income stocks and they will do it because they like dividend stocks, you might hear too. They will do that because they want to offset their margin payment. So they might use margin, but then they might get a whole bunch of income and dividend stocks to help offset that payment so they don't have to come out of pocket to pay any of that. So my thing is you should instead use cash flow, whether it's from real estate, your job, like a business. You can find cash somewhere to grow faster with growth stocks than you can with dividend stocks. Dividend stocks, it's going to take you so long to make a meaningful amount of money. I showed in my last video, you should go check it out, where what I would rather do is grow exponentially. And then if I want to, sell some of those shares to pay off that debt, which is just so cheap. It's just so cheap, you guys. Let's take a look here what I mean. Like, I'm sitting at less than 6% interest. As long as I'm earning 15, even 10% interest, like 10% return on my stocks, in the last year, I'm up 30%. If I'm earning even 10%, I get to keep the 5% spread on hundreds of thousands of dollars. That's incredible. So let's get into dividends a little bit. I kind of got off topic there, but let's go check out. You can always find them on Fidelity. Here I can maybe find them on Yahoo. Probably not performance. Let's go like this. Let's say VGT. Let's make it simple, right? Might show here, might show here. Let's see which one we like better. So here on stockanalysis.com, you can see the last dividend payouts. So it paid 85 cents a share. You can see in June it paid 70 cents a share, paid 72 cents a share. So it's like 70, 75 cents per quarter, roughly. In a year, you get $3.07 per share that you own in 2025 here when we're looking. So I own hundreds of shares of VGT, and that helps me offset my payment by quite a bit here. So I don't even know how many I own. Let's see here. I own 542 shares. So I'd multiply that by the 70 some cents, the 85 cents per share, and I got something like $465 in dividends just from VGT. All of my portfolio pays for about a third of my margin payment. So it's not the same as chasing income stocks. However, it does help me pay for about a third of it. And then for the remaining portion, I have to go and I have to make money from what I do for a living, which is sell houses and lease apartments to people. That is what makes me money. And then this grows passively in the meantime. So let's look at what would, let's say VOO, right? And VOO is going to pay a little bit more. And then stuff like SCHG and VUG are going to pay not very much. God dang it. So here VOO pays a much better ratio and it pays $7.04 per share per year. So the share price is comparable, but you just get such a better dividend that it makes a better anchor for your portfolio and gives you a little bit of protection against volatility. So let's go back to VGT. It's like double the payout ratio of VGT. That's pretty freaking nice. Let's check real quick VUG. And then 17%, so that's like slightly better. And then SCHG. So I am not here chasing dividends like so many people. I think that it's better to get growth. And then your opportunity really arises when the market dips, you buy as much as you can. I use margin during that time. And then when it comes back up, what I'm doing is I'm paying off my margin with money that's coming in from other sources, whether it's real estate, whether it's money from real estate commissions, it doesn't matter. Like that's the strategy, guys. So expense ratio, that's your last one here. And expense ratio is how much it costs you per year. So 0.2% on a $100,000 portfolio in a year is going to cost you just like, I don't know, 20 bucks, something like that. Don't think you can see my calculator here, but it would cost you $200 per year to own this instead of putting your money with a financial advisor. That same $100,000 would cost you, let's say 1%, let's say 1.5%. It would cost you $1,500 versus $200. Doesn't sound like a big difference, but as your portfolio gets bigger and bigger, and also keep in mind, they aren't really allowed to show you strategies like this. So you're really missing out on, even if they want to help you more, they can't. It's, what is that, 1,500 divided by 200? It's 7.5 times as expensive to use a financial advisor than it is to have a 0.2% expense ratio. And here's the thing, a lot of these are even lower expense ratios than 0.2. What I mean is, let's see, VGT expense ratio is 0.09, so it's half of that. So it's it's less, it's $100 a year, like $90 a year to manage a $100,000 portfolio. That's nothing. You don't have to go think about which stocks to buy. You don't have to think about moving your money around. Like, this is a pretty nice, I wouldn't say set it and forget it strategy, but this is the way. So that's all I got for you guys today. Next time, we might talk about my cash flow sheet here, and this is going to be more along the lines of maybe budgeting. I don't know about budgeting, but it's going to be like managing your net worth, kind of tracking your net worth and what I track, how I track it, and give you a nice setup for how you can do this in Google Sheets here. So that's all I got for you today. See you next time.